Welcome back to another video. Soil here, and today I want to talk about a very powerful indicator that is called Darvas Box. This indicator was created by Nicolas Darvas in the late 1950s, and by the help of the trading system that he built based on this indicator, he could turn a $10,000 account into $2 million over an 18-month period of time. Because of his amazing success with his trading system, later in 1960 he wrote a popular book, How I Made $2 Million in Stock Market, in which he completely explained about Darvas Box and the trading system that he developed based on this indicator. The Darvas Box trading system is a trend following strategy which discovers when the momentum is gaining strength so we can ride on the trend to make profit. Just like any other trend following strategies, here with Darvas Box system we don't try to anticipate, but we try to be reactive on what is happening in the market. In the times that Nicolas Darvas developed Darvas Box indicator, computers had not been invented yet, so he did everything by hand on papers. He just collected the data from newspapers and telegram, and he drew the chart and lines by hand. The rules of drawing Darvas Box, which he explained in his book, is very simple. First, the price must break 52-week high. Consider, for example, this is 52-week high, and this candle broke our 52-week high here. When this candle is closed and the high is set, after that there are 3 consecutive days that do not exceed this high. When this happens, this new high becomes top of the box, which we draw it like this. And for the bottom of the box, the breaking candle which broke the 52-week high, its low becomes low of the box unless new lows lower than this low are formed after that, which is the case as you can see here. So the low of this box would be here at this low of this candle. We have the same rule for the low of the box. When it's broken and 3 consecutive candles don't go lower, the new low becomes the low of the box. Whenever top of the box or bottom of the box is broken, based on the rules that I just explained, they are readjusted if the conditions are met. And as you probably realize by now, when the Darvas Box is broken, it's a trading signal. For example, here you can see that the price broke top of the box and it's a buying signal. These days we have access to real-time charting, and we can have complex mathematical functions on our chart just simply by a few clicks. And Darvas Box is not an exception, and we can add it to any chart or any time frame here on TradingView. For adding it to our chart, here we click on indicators and we search Darvas Box. We add this one, which is written by Kivong Ozbilgic, if I'm pronouncing the name correctly. Alright, as you can see, Darvas Box is automatically calculated and added to our chart. Now let me explain Nicolas Darvas' trading system and how he traded based on this indicator. He traded on stock market. So here I have Apple chart to be able to explain in the exact context, but no limitation on this, and the same concept can be applied to any other asset or market, and you can use Darvas Box indicator on any time frame. And please pay attention that by default the box length is set at 5, which depending on the asset and volatility of the market you're trading, the time frame you're trading, and also your trading strategy which you want to use Darvas Box in that strategy, you may need to increase or decrease the length. Alright, as I said earlier, Darvas Box trading system is a type of momentum strategy which we try to find out when the momentum is gaining strength so we can ride on the trend to make profit. When the price breaks top of the Darvas Box and exceeds the high by a few points, it's a buy signal. From his book, the entry price was usually about 1 to 2% above the upper box limit, but I suggest it's better to wait until the candle is closed above the box. And if you're trading on derivative markets, similarly you can open short positions when the price breaks the bottom. Placing stop loss and controlling the risk is very important in this strategy, as he explained in his book. The initial stop loss should be set pretty tight, just below the high of the old box which was just broken. Below the low of the breaking candle would be a good place. And then as the price moves into each new box and breaks it, he suggested adding to the position and trailing the stop loss below the low of the most recent box. So we add to our position after this breaking and we move the initial stop loss to here, and we continue this until our stop loss is hit. He also suggested if you entered a position and then the price came back to the old box, for example here you can see that after entering a short position here, the price came back to the old box. He suggested that when this happens and the price comes back to the old box, you must instantly close your position, and if you get another same signal, again you can enter the same trade with the stop loss at the same place according to your breaking candle, which would be here. By doing so, you will be able to cut part of the loss. For example, in this case, the breaking candle is small, but if it was a longer candle and our stop loss was, for example, around here, so cutting the loss and closing our position around here would cut the loss, and this is what he suggested in his book. Nicolas Darvas highly recommended that the trades should be in the overall trend of the market and not trading when the market is in a trading range. For example, we can add a moving average to our chart with length of 200, which can help us with the overall trend of the market. So when the trend is up, we only take long positions, and when the trend is down, we only take short positions. There is another indicator which we search again, Darvas, this one, Darvas Box buy sell, which is written by someone named Sehun, which is exactly the same indicator, but it also shows buy sell signals when the price breaks above or below the Darvas Box. I'm gonna make a special video on this indicator soon, a trading strategy based on these buy sell signals. Just make sure you subscribe so you won't miss it. Alright, although the Nicolas Darvas strategy is largely based on technical analysis, but Nicolas Darvas combined it with fundamental analysis. For example, he checked the overall trend of the market and only bought when it was in the direction of the overall trend. He recommended not buying stocks when the major indexes are in a bear market or when volume is flat or declining. He also checked whether the stock was in a strong sector with increasing volume and rising earnings. So you must pay attention that the strategy that Nicolas Darvas used was a combination of technical analysis and fundamental analysis, and he only took positions in stocks that were both of technically and fundamentally strong. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.